Can Taxes and Bonds Finance Government Spending? By Stephanie Bell. Section 3. Strategies for Reducing the Reserve Effect. In the preceding discussion, the effects of government spending and taxing on bank reserves were examined by assuming that all disbursements and receipts were immediately debited to the Treasury's accounts at Federal Reserve banks. This treatment allowed us to highlight the impact of each of these operations on the level of bank reserves, but it did not paint a realistic picture of the way things currently work. If things did indeed work this way, there would be an unrelenting disruption of banks' reserve positions and, subsequently, chronic turmoil in the funds market. Because these consequences are highly undesirable from a policy perspective, some important strategies have been developed to mitigate these persistent yet unpredictable reserve effects. Let us move to an examination of these techniques. Section 3.1. The use of tax and loan accounts. The disruptive nature of the Treasury's operations was recognized under the independent Treasury system and ultimately led to the use of general and special depositories, private banks in which government funds could be kept. Footnote 7. The independent Treasury system was, in effect, long before the establishment of the Federal Reserve System. It was established in 1840, abolished the following year, re-established in 1846, and discontinued in 1921. Footnote 8. General depositories have become known as remittance option banks, while special depositories are currently referred to as note option banks. Both are depository institutions with tax and loan accounts, but a remittance option bank, like its predecessor, the General Depository, must remit its tax and loan account (T&L) balances to a reserve bank the day after the funds are received. In 1978, note option banks were given the opportunity to accumulate the daily tax payments they receive by transferring them from the ordinary tax and loan accounts, where they are held interest-free for 1 day, into an interest-bearing note account. Up to a pre-approved limit, these funds can remain in note accounts until the Treasury calls for them to be transferred to reserve banks. This was the first important strategy developing to mitigate the reserve effect. As Ranlett recognized, the reserve effect caused by the point inflow continuous outflow nature of Treasury activities could be tempered by placing certain government receipts into tax and loan T&L accounts at private depositories. Thus, the reserve drain that would otherwise accompany payments made to the government could be temporarily prevented. Footnote 9. In this case, a distinction between the supply of money and HPM, high-powered money, should be made. When tax receipts are placed into tax and loan account, high-powered money, bank reserves, and currency outstanding is not affected. The money supply, M1, however, is. When funds are transferred from demand deposits, where they are part of M1, into tax and loan accounts, or the Treasury's account at the Fed, which is not part of any standard measure of the money supply, M1, M2, etc., the money supply declines. The benefits of using these depositories were quickly recognized, and their functions were broadened whenever it became clear that they could be used to further mitigate the reserve effect. As the size of the government's fiscal operations grew, special depositories quickly became the most important group of bank depositories. As Figure 3 shows, just over 2/3 of all federal tax receipts are currently deposited directly into tax and loan accounts. Today, the tax and loan accounts are by far the most important device used to guard the money market against the sizable daily differences shown in Figure 2 between the flows of government receipts and disbursements. Section 3.2. Managing the Treasury's balance at the Fed. Since almost all government spending involves writing checks on accounts at the Fed, virtually all funds in tax and loan accounts must eventually be transferred to reserve banks. Footnote 10. This is not because the government needs the proceeds from taxation in order to spend again, but because it chooses to coordinate its taxing and spending. This will be taken up in the final section. Because only net changes in the Treasury's account at the Fed impact the aggregate level of reserves, ceteris paribus, maintaining the Treasurer's balance with the reserve banks at a reasonable constant level is the second strategy used to minimize the reserve effect of the Treasury's operations. Specifically, the Treasury aims to maintain a closing balance of $5 billion in its Federal Reserve checking accounts each day. Figure 4 shows how successful the Treasury is in its endeavor to maintain its target closing balance. Recall that the government receives funds into its accounts at the 12 reserve banks as well as thousands of commercial banks each day, but that nearly all government spending is done by writing checks on accounts at reserve banks. Maintaining a closing balance of $5 billion at reserve banks then usually requires transferring the appropriate amount from tax and loan accounts to the Treasury's account at the Fed. For example, if the Treasury expected to receive $5 billion directly into accounts at reserve banks today and expected $6 billion in previously issued checks to be presented for payment today, $1 billion will need to be transferred to the Treasury's account at the Fed today, so that there will be no net change in the level of reserves. The Treasury transfers funds to cover anticipated shortfalls by making a call on tax and loan accounts. In most cases, advance notice is given before transferring funds from these accounts. Footnote 11. Special depositories or note option banks fall into three categories: A banks, B banks, and C banks. A and B banks are typically smaller institutions, while depositories that are classified as C banks are generally large banks. Tax and loan calls are calculated as fractions of the book balance in each tax and loan account on the previous day. Calls made on A and B banks are usually made with longer lead times than calls made on C banks, and the latter are usually the only banks against which same-day or next-day calls may be issued. A reverse call or direct investment is also possible. This would be necessary if the Treasury's closing balance at reserve banks was expected to substantially exceed $5 billion. Footnote 12. The closing balance in the Treasury's account at the Fed could exceed the large level for two reasons. First, previously placed tax and loan calls may have been too large. In this case, the amount of spending from accounts at reserve banks is less than the sum of the payments received directly into accounts at the Fed and the amounts called from tax and loans. Second, it is possible that the payments made to the government and deposited directly into accounts at reserve banks exceed the amount presented for payment from these accounts. This could happen, for example, during months in which quarterly tax payments sent directly to accounts at the Fed are large enough to more than compensate for government spending. To avoid the reserve drain that would result from an excessive closing balance, the Treasury may place some or all of its excessive funds into tax and loan accounts at note option banks. Footnote 13. The Treasury will not, in all instances, be successful in its attempt to directly invest its excess funds. Some note option banks will not meet the collateral requirements and will be ineligible recipients of additional tax and loan funds. Additionally, tax and loan accounts, like the Treasury's account at the Fed, may swell during unusually heavy quarterly tax payments. Because banks must pay interest on tax and loan accounts, they limit the size of tax and loan balances they are willing to accept. When direct investment is not an option, the Treasury can attempt to cancel previously scheduled calls in an attempt to draw down its balance in reserve banks. Whether calling funds from tax and loans to make up for an expected shortfall, or transferring funds to tax and loans through direct investment, or canceling previous calls to prevent an excessive closing balance, the amounts transferred are intended to maintain the Treasury's balance at reserve banks as steady as possible. In pursuit of this goal, the Treasury relies on the cooperation of the Federal Reserve. Section 3.3 Coordination with the Federal Reserve. The Federal Reserve is extremely interested in helping the Treasury achieve its target closing balance because the Treasury's balance at the Fed is often the biggest source of uncertainty about reserve levels. Indeed, the Fed's ability to successfully conduct monetary policy, specifically to hit its target funds rate, depends to a large extent on the Treasury's ability to hit its target closing balance. Daily contact between the Treasury and the Fed provide the Treasury with numerous occasions to assist the reserve authorities to achieve a desired objective. Unfortunately, the Treasury is unable, even with the cooperation of the Federal Reserve, to completely offset the effects of its daily spending using tax and loan calls and direct investment. Indeed, as Table 1 shows, the Treasury's average monthly closing balance can differ substantially from its $5 billion target. This again is the result of the inherent uncertainty regarding the size, timing of receipts and expenditures. That is, because the payments coming into going out of the Treasury's account at the Fed can never be precisely known in advance, transfers to from tax and loan accounts will not normally offset exactly the shortfall excess in these accounts. Thus, as Figure 5 confirms, one expects a non-zero change in the Treasury's daily closing balance. Despite this, changes in the daily closing balance do tend to fluctuate fairly closely around zero, deviating most drastically with quarterly tax payments. In sum, 3 important points have been made regarding the Treasury's options. First, the Treasury recognized the disruptive nature of its cash operations and responded by maintaining accounts at private depositories. Second, the Treasury uses these accounts to diminish the reserve effect of its operations by using tax and loan calls and direct investments to minimize the net changes in reserve account balances, to coordinate the flow of its receipts with its expenditures. Finally, the Treasury and the Fed cooperate to bring about a fairly high degree of harmony in managing the Treasury's balances at reserve banks.